Banks are stupid. In 2008, they crashed the entire financial system. And today they are trying to hide roughly $500 billion in losses. And this is why I never buy bank stocks. You see, the financials of a bank almost always look good on the surface. That's because they don't have to report all of their losses in quarterly earnings reports. Instead, they are buried in accounting rules that allow banks to label them as temporary, but make no mistake, they are very real, and they are quietly eating away at the financial foundation of the banking system. Because here's the real danger. Banks rely on confidence. These losses only remain paper losses if depositors stay calm. But if confidence cracks, if customers start pulling cash like they did at Silicon Valley Bank in 2023, banks have to sell assets at a loss. And these hidden paper losses instantly become actual capital hits. And that is when solvency issues go from theory to reality. Think of it like termites in a house. From the outside, everything looks fine. But underneath, the structure is being weakened day by day. What they have are known as unrealized losses. You see, an unrealized loss happens when the market value of an asset falls below what you paid for it, but it hasn't been sold yet, right? So on paper, the bank still owns the asset, so the loss is not officially counted. But economically, and from a common sense standpoint, the value has already been eroded. Now with banks, this shows up in their bond portfolios. You see, banks are required to hold safe assets like U.S. Treasuries and mortgage-backed securities. But the problem is bond values move in opposite direction with interest rates. So let's say, for example, let's pretend you purchased a $1,000 Treasury bond in 2021 that paid you a 2% yield. So every year you get an interest check for $20, and when the bond matures, you get your original $1,000 back. Now fast forward to today, where new treasuries pay around 5%. If you have to sell that bond, nobody is going to pay you $1,000 for it. They don't want your old 2% bond when they can buy a brand new one that yields 5%. So you would have to sell it at a discount to make up for the lower interest payments. Now imagine you're a bank that bought $50 billion of those 2% bonds. If you were forced to sell them, you'd be locking in the loss. Your unrealized loss would become very much realized. Now look, as long as the bank holds the bonds to maturity, that loss stays hidden in the background. They're only making 2% on the money, but their initial investment does get returned. The danger comes when liquidity is needed. You see, if depositors start withdrawing funds, a bank is forced to raise cash very quickly, and to do that, it has to sell some of its bonds. And as we said, those bonds are worth far less than what they paid for them. Now, this is not just a theoretical problem. This is exactly what triggered the collapse of Silicon Valley Bank in March 2023. SVB held tens of billions of dollars in long-term bonds bought during the zero interest rate era. And when rates spiked, the value of those bonds plunged. Now, on paper, the losses looked manageable until depositors got spooked. They rushed in to pull out their money, and the bank had no choice but to sell these bonds at massive losses to raise cash, wiping out its capital base almost overnight. And in less than 48 hours, one of the largest banks in the country went from stable to insolvent. And this was a harsh reminder that confidence is everything in banking. The second that trust evaporates, paper losses stop being theoretical and start destroying real-world balance sheets. Now, some people have asked, look, why do they hold so many bonds then if they're carrying this kind of risk? And part of that answer is regulation. After the 2008 financial crisis, rules were tightened to make sure banks always had a cushion of safe, liquid assets. Treasuries and mortgage-backed securities fit that requirement perfectly, because they are backed by the U.S. government. They can be sold quickly if cash is needed. But regulation is only part of the story. Banks also face the challenge of what to do when deposits pile up faster than loan demand. So if customers put billions of dollars into a bank, but they don't have enough qualified borrowers to lend that money to, the bank can't simply let the cash sit idle. Idle cash earns nothing. It drags down profitability. So banks then turn to bonds. And by investing in Treasuries or these MBSs, they can earn a steady, predictable return while still keeping the asset safe on the balance sheet. So in theory, it is a win-win. Bank stays compliant with regulations. The excess deposits generate some income instead of gathering dust. The real problem is timing. You see, in 2020 and 2021, as I said, banks were drowning in deposits, stimulus checks, PPP loans, record household savings just flooded the banking system, trillions of dollars in cash. And at the same time, interest rates were near zero. And that left banks with a decision. Either sit on piles of idle cash, earning nothing, even though they still have to pay salaries and expenses and everything else. They're not charities. Or they invest in the safe long-term treasuries and mortgage-backed securities. Well, most banks chose the latter. They snapped up bonds paying 1% to 2%, thinking they're locking in steady income on these rock-solid assets backed by the U.S. government. It seemed like the conservative move. But in 2022, the Federal Reserve pivoted. They had to fight runaway inflation. And they launched one of the most aggressive rate hiking cycles in modern history. In less than 2 years, the Fed raised rates from basically zero to over 5%. And again, bond prices go down when rates go up. So as the rates rose, the market value of those older, low-yield bonds plunged, and banks were left holding hundreds of billions of dollars in embedded losses. This is how what seems to be a safe investment strategy turns toxic, not because the bonds were risky, but because the timing was bad. And the scale of this problem is enormous. By late 2023, a 10-year Treasury yield climbed above 4.5%, and the unrealized losses sitting on the balance sheets of U.S. banks ballooned to around $684 billion. That is roughly the GDP of Sweden. Now, the yields have eased just a little bit in 2024 and into 2025, but the damage has not gone away. As of Q2, banks are still carrying around $395 billion in unrealized losses. So to put that in perspective, that's about 1/5 of what they call their Tier 1 capital. In other words, for every dollar of capital, one of those is already underwater. Now, on the individual level, when it comes to these small and regional banks, some of them have very large losses. Losses that if marked to market would wipe out their entire capital base, not 1/5 of it. Again, on paper, these banks look solvent. But if they were forced to liquidate their bond portfolios today, they would be functionally insolvent. And most of these losses are concentrated in these long-dated mortgage bonds, locked in at rates around 3%. Now, listen, these bonds will eventually pay back in full, but until then, they are frozen assets. Banks cannot sell them without realizing huge losses. And what that does is tie up capital that could otherwise be used for lending to businesses and homeowners and entrepreneurs. So this really is why credit conditions are tightening. Commercial real estate loans, housing, small business credit, they're all feeling the squeeze because banks are sitting on these massive portfolios of bonds that they cannot touch. And even if they wanted to, even if they said, you know what, let's just tear off the Band-Aid, sell them, take the hit, they can't. Because once these losses are recognized in the bank's books, it will slash their capital reserves. And regulators require banks to hold a certain cushion of capital. And some banks today have unrealized losses so large that if they were realized, those banks would fail regulatory requirements instantly. And this creates a trap. Banks can't sell the bonds without crippling their capital. But by holding them, they are tying up resources that could otherwise be used for new loans. It's like being stuck with a mortgage you cannot refinance, all while watching the market move against you but unable to do anything about it. This is the same trap that helped topple Silicon Valley Bank. They finally admitted that it had to sell part of its bond portfolio to give depositors their funds. This created a multi-billion-dollar loss. And that single disclosure, as soon as it became public, shattered depositor confidence. Within hours, customers were lined up at every branch trying to pull out their money, forcing even more losses and triggering one of the fastest bank runs in U.S. history. Deposits are the wild card. As long as depositors keep their money parked and continue to bring new money there, banks can wait for bonds to mature and eventually get paid back in full. That's why consumer confidence is the greatest strength of any bank. They must project an image of strength and safety, even when they are bleeding billions. You show one chink in that armor and you become the next Silicon Valley Bank, Signature Bank, or First Republic. Now, just for the record, these banks did not break any laws. They didn't make wild, risky bets. They lost the trust of their customers. And those customers all raced to pull out their money. Billions left in just a few hours. And their balance sheet collapsed under the weight of their forced bond sales. Now, for most of us, this is not a problem. Even if there was a run on the bank, accounts are insured up to $250,000 by the FDIC. It would be inconvenient for a few weeks, but we would be made whole. The Federal Reserve also built safety nets, like the Bank Term Funding Program, which allowed banks to borrow against their bonds at full face value. But that expired in 2024. That program acted like a pressure valve, giving banks time to ride out the losses without selling, hoping yields would come back down and their bond price values would rise. But with that gone, banks have fewer options if depositors do suddenly demand all their money back. As long as trust holds, the system limps along. But if it breaks, the house of cards comes crashing down. Now, regulators are well aware of the risks. As of this year, 59 banks sit on the FDIC's official problem bank list. Now, that number doesn't sound huge. After all, there's thousands of banks in this country. But history shows us it only takes a handful of failures to shake confidence. The FDIC's fund is like a fire extinguisher. It works for a small blaze, but if an inferno breaks out, it will run dry fast. Now, equity markets already understand this vulnerability. Today, bank stocks trade well below their stated book value, a sign that investors don't fully trust the balance sheets, as they shouldn't. Credit rating agencies have been downgrading outlooks, especially for these small regional banks that either lack the scale and diversification of the big guys or those that went neck deep in 10-year paper on a 1.5% yield. So the regulators, God bless them, are in this kind of constant balancing act. They don't want to cause panic by overstating the risks, but they also know confidence can unravel quickly if the public starts questioning whether their deposits are truly safe. And look, this is not the first time that the banking system has been caught in a trap. Human behavior being what it is, history tends to repeat itself. In the 1980s, the savings and loan crisis followed a nearly identical script. Savings institutions held long-term fixed-rate mortgages on their books. And when interest rates soared, those mortgages lost huge amounts of value. Again, on paper, the institutions looked fine. But as withdrawals mounted, the losses became real and hundreds of savings and loans collapsed. The final cost to U.S. taxpayers was north of $100 billion. Fast forward to 2008, and the pattern resurfaced in a different form. That crisis was credit-driven, not interest rate-driven, but the dynamic was the same. Banks carried assets that appeared solid on the surface. Mortgage-backed securities rated AAA. Yet in reality, the value was collapsing. Confidence eroded, liquidity disappeared, and the entire financial system was thrown into chaos nearly overnight. But the lesson here is clear. Once confidence evaporates, accounting categories and regulatory labels no longer matter. What matters is whether depositors and markets believe a bank's assets are sound. If they don't, withdrawals accelerate, fire sales begin, and the liquidity crunch turns into a solvency crisis. Today's unrealized losses are not toxic subprime mortgages. They're not worthless loans. They're U.S. Treasuries and agency-backed bonds. Assets that will eventually pay in full when they mature. The danger is not credit quality. It is timing, liquidity, and trust. And history shows that when these three collide, paper problems sometimes ignite into a full-blown crisis. Now, if you haven't already, hit the subscribe button down there in the corner. That way you won't miss these updates on your YouTube channel, and I'll see you in the next video.